I'll start with a bit of a recap. So in my last talk last year, which I'm sure you all remember, we talked about leases and the fact that from 1 January 2019, lease accounting was going to be relevant to all general purpose financials. So I've just noted the exceptions. So if you have short-term leases where the lease is less than 12 months, or if it's a low value lease where the total cost of the asset was like $5,000 or less, you don't have to take up this standard. So just as a recap, this standard basically means that all leases that were operating now become balance sheet. So taken out of the P&L and moved to the balance sheet. So this mainly impacts your rent. It impacts motor vehicle leases. It could impact things like forklift leases, potentially photocopier leases. So those are the areas that generally people get caught out by. Low value, we're usually talking about laptop leases. So they would fall in the low value category. Or if the motor vehicle lease has only got 12 months to go, they would be exempt. So note that this standard will also impact on clients that choose to early adopt general purpose financials per my previous slides. So they will need to also be aware and prepare for it. Once again, this impacts your cash flows. Well, sorry, no, it doesn't impact your cash flows. It impacts your gearing and your loan ratios, and it could impact on remuneration schemes where financials are used as a basis. So just little things to be mindful of. Okay, so when we look at what the key issues from clients that have already adopted lease accounting. So these are some of the issues that we've observed. The commencement date is not often correct. It is not the date that the contract is signed. It's the date that it's available for use. So please make sure your clients are using the right commencement date. The other thing to be aware of is that so basically these leases, they need to be discounted to present value. However, every time the lease changes, so where you've got a CPI increase or it's been renegotiated, so previously the lease was for 10 years, it's been renegotiated either downwards or upwards. At that point in time that the lease changes, you actually need to recalculate the present value of the lease based on the remaining lease term. And you also got to recalculate the incremental borrowing rate. So the incremental borrowing rate, it's basically the rate that affects your calculation of what the asset or the liability is going to be, because it's the rate at which it's discounted. There are a lot of clients who really don't understand leases. I myself have seen at least 4 clients who I've asked them, oh, have you got your workbook on leases? And they're like, yeah, sure. And what they send me is not at all what they need to do. It's very, very simplistic. So I would say as an accountant, this is a really good value add and potentially a service you could provide to them to actually do this for them, or provide them with a template that could assist them, and also let them know what the areas are that they often would have issues. So the incremental borrowing rate is one of these areas. Most clients don't know what this rate is. It's basically the rate that you would expect the company to pay if they were to go out to market and borrow for a similar term using a similar security in a similar economic environment. And you then have to look at this rate for each individual lease that you have, because each lease has different terms. However, saying that, there is an ability where if leases have got similar terms and similar nature, so a good example would be, say, rent. If you've got multiple facilities, if they've got rent that is all pretty much 3-year contracts, you can group them together and you could show it as one lease that's the total using this the same borrowing rate. Now, saying that, how do the client work out what the borrowing rate is? I mean, it's not so easy. It is not their external borrowing rate. So if they've got borrowings and it's borrowing at 4%, that is not the rate you would use, but it is a rate that you would consider as a factor. So there is actually a process that you would go through to develop an estimate of your incremental borrowing rate. As a starting base, you would just look at your base rate. So federal bond rate or the BBSW rate for the similar term lease. So 5-year lease, 5-year federal bond rates. That's your starting point. Then you need to add your credit risk onto that. So if you've got unsecured loans, or if it is something like rent where the lessor can take ownership of the asset and repossess it, that will affect your credit risk. So that would just, you could tweak that initial base rate upwards or downwards. If your entity doesn't have borrowing, so they don't know what's the starting rate, you can use the entity's equity cost of capital, because that's basically the nature of a loan to an entity with a high credit risk is close to that of an equity investment. So that's something you can consider. It is really important that once clients have gone through this process, that they document their process and their thought process around it, because the auditor is going to need to be able to see this. So they need to do it before the audit. In some situations where you have funding from a parent entity, and if there's no external borrowings, you could potentially use a parent's incremental borrowing rate, something to consider. Okay, so now most of you are thinking, oh God, that's a lot of stuff to take on. And especially if you're going to change this incremental borrowing rate every time the lease changes, what's happened now in the COVID climate where you're getting deferral of rental, you're having rent-free periods, you're getting subsidies? There is good news. So there is an exposure draft, COVID-19 ED 300. It has not yet passed. They're expecting it to pass the end of this week or early June. And it's applicable for 30 June 2021, but it allows early adoption. So the benefit of this exposure draft, it applies to all, mainly rental leases. It applies to all modifications to leases that occur as a result of COVID. Where you've had that happen, you don't need to adjust the incremental borrowing rate, and you don't need to remeasure the liability as a result. So this is really, really good news. You have to recognize the actual impact. So if you've got deferred rental, that's basically treated as an interest-free increase to the lease liability. If you've got any forgiveness of rent, that's treated as a gain in your profit and loss, and I've showed the journal entries that you would put in for that. Any gains or losses must be disclosed in the financials, so that is some good news. Okay, so we've calculated the lease correctly, we're comfortable with it. What do we do about the comparatives? Do we have to adjust it? You don't have to adjust it. There is a ability to take what's called the modified retrospective 1 and 2 approach. I know a lot of technical jargon, but basically this is highly recommended because you don't adjust your comparatives, and you basically take the lease liability measured as at 1 January 2019. So you look at your future lease payments from 1 January 2019 onwards, and then the borrowing rate that you would apply is the rate as at 1 July 2019. So that's pretty good. It just makes life a lot easier. So I would definitely recommend that you do that. Okay, with leases comes a lot of additional disclosures as well. I have put here some template wording that you can use. However, this is not exhaustive. There's actually more wording that you would need to do. If you would like that wording, drop me an email. I also have a template that you can provide clients. I think this template originally came from a BDO training that was done. I'm not sure. It was actually, I received it from a client, and I've modified that template to just make it a little bit easier. So let me know if you do want to borrow it, happy to, but I suggest you just check it as well in case I've made any mistakes. I've only used it twice for 2 clients so far. But yeah, so I put here some wording that you would need to be using. Basically just says you've adopted it retrospectively. As a result, you're not changing comparatives. Pretty much what it says.